Hey there everyone, this is John Hager. We'll be talking about taxable income today. This is going to be a little bit different than the other videos. We're going to be breaking down line by line. Today we're going to be broadly speaking about how is tax, this is like tax 101, here is how do we figure out what taxable income is, okay? So when you figure out, I wrote out the formula here. So, and this isn't actually complete yet, I'm not done yet with it, but we got your gross income. This is line 22 of the first page of it, okay? We subtract the adjustments or add them in, depending on if it's, depending on your circumstances. But then after we do it, we get the adjusted gross income here, AGI. Next we have your standard deductions, which for most individuals is $6,300. It goes up if you're blind or you're over the age of 65, and whether your spouse is blind or over the age of 65 as well. Okay, so take the AGI, subtract your deductions, which for most people is either $6,300, $9,300, or $12,600. If you made less than that, you essentially didn't make anything. Your taxable income is zero. But we still have your exemptions to think about. If you claim yourself, that's another $4,000, $4,050 as of 2016. If you can claim your spouse, or if your spouse is filing with you, it's another $4,050 of income you can make without paying taxes on it. If you have kids, another $4,050 a piece. If you can claim your parents living in a different out of the house or in a different country, Canada or Mexico, again, another $4,050. So essentially, if you have 5 kids, you can make up to $40,000, no taxes paid. No taxes due unless you're self-employment income. Alright. That gives you your, after exemptions, that gives you your taxable income. Okay, so taxable income is what we figure taxes on. This one gets a little complicated. If you have, we have a progressive tax system in the U.S., which means that everyone pays the same rates. If on your first 10,000, okay, I have the married filing jointly or qualifying widower up. Let's bring up the tax table for if you're single. 2016. Alright, so on your first $9,275 of taxable income, you pay 10%. This is everyone. If you made more than that, so between $9,275 of income and $37,650, you pay 15%. Now, on the amount you made that's taxable, so that's after your exemptions and deductions, over $37,650 up to $91,150, you pay 25% of that in tax. So it's a mixed rate, and it goes up from there. 25% up to 91,000. Between 91,150 and 190,150. Put you in a 28% tax bracket, so 28% of your income goes to taxes. We have 4 more rows there. We're not going to go into those right now. The point is, progressive tax system means that everyone pays the same amount on each amount of income. Let's say I made 100,000 and my neighbor made 10,000. I don't pay 20% on my 100,000, and they only pay 15% on theirs. They pay 10% on the first $92,075 worth of income, and then 15% on the rest. I pay those as well as up into through the 28% bracket. Okay, this is one of the most it's a simple issue, but it's very difficult for people to wrap their minds around. I think it's because when they see this form, they're like, "Oh, I don't know anything about it." Let's see here. Oh, last thing here is, if you received credits. So this would be like the foreign tax credit, child tax credit, the education credits from, like, if you or your child went to a college, you went to college, and you paid out pocket expenses or had to take loans. That's a credit. There's a credit for that. There's a credit for contributing to a retirement savings account. What are credits? Credits are almost like they're one-to-one reductions in your taxes owed. So let's say I owe $1,000. I have a kid. For a child tax credit, my child tax credit nets out against my $1,000 taxes owed. Means I don't owe anything. And this gets to the point of, if you with proper tax planning, you shouldn't have to pay in or receive anything back at the end of the year. Okay. There's other taxes applied after credits, such as the self-employment tax. Let's say you made $2,000 last year and it was only self-employment. Well, you still have to pay self-employment tax on that $2,000, even after your exemptions and deductions. After the other taxes are applied, then they take your payments. So this is the amount you had withheld on your W-2 and 1099s if you had any. It's also where the earned income credit comes in. This can wipe out self-employment tax penalties. The earned income credit, if you qualify for it, should be a part of your tax planning procedures. We'll go over tax planning in another video, but just to recap, it's adjusted gross income, or it's gross income minus and add adjustments, subtract deductions, compute tax, remove credits, add in other taxes, again, offset your payments against the taxes owed, other credits such as the earned income credit, and that helps you figure if you are due a refund or you owe in more. Okay, John Hager signing up.